Hi, Bill Lethman here from Lethman Financial. Welcome back to part 4 of our 4-part series on rethinking retirement income. In this video, I'm going to show you some tips and strategies that can help you to minimize some of the risks that withdrawals can have on your portfolio. Our goals are going to be to build a plan to create lifetime income, invest in a way that will give you the greatest probability for success, keep enough cash and liquid assets to reduce the chance that you'll be selling in a down market, and create a rebalancing strategy. So to minimize the impact that withdrawals can have on your portfolio, we recommend a bucket strategy. The first bucket is what we call your income now bucket. In it, you should keep 1 to 2 years worth of cash flow needs in very liquid assets like checking and savings accounts, money markets, or CDs. This is so that you won't have to liquidate parts of your portfolio to cover your living expenses. The second bucket is your income later bucket, and here you should keep an additional 2 to 3 years worth of cash flow needs. These types of investments would include CDs, short-term treasuries, or other high-quality bond investments that will mature in less than 5 years. The third bucket is your long-term bucket. Depending on your tolerance for risk, here you'll have investments designed for growth and to keep up with inflation. This will be your stock or equity investments, maybe some convertible bonds, real estate investment trusts, and high-yield bonds. And finally, your legacy bucket. Not everyone has this. If you've determined that you have more money than you will likely spend in your lifetime, you may want to invest a part of your money as would be appropriate for your beneficiaries' needs and goals. This is probably money that has a much longer time horizon, maybe for education expenses for grandkids or for your kids' retirement. This bucket will likely be invested for growth with a long-term objective of creating and maintaining wealth. Let's talk about a rebalancing strategy. Our main goal here is to always keep your first bucket full. We accomplish this a couple of ways. First, by having all the dividends and interest from the second bucket pour over into the first bucket. Secondly, on an annual basis, we will do a major rebalancing of the accounts. First, we'll make sure that bucket 1 is topped off with at least 2 years of cash flow. This will be funded with maturing assets from the second bucket. Lastly, if we have to, we will refill the second bucket from assets from the third bucket. Another thing, we want to be careful not to let our first bucket get less than 1 year's cash needs. If it falls below that level, we rebalance immediately, even if it's more frequently than once a year. So, the basic rule that we're following is replenish the cash first, then the short-term bonds so that we minimize the effects of having to sell our long-term investments when the market's down. Let's talk about some options for creating income. Ideally, you'll want to keep bucket 1 filled with the dividends and interest that you get from your portfolio. Here's a few options for creating retirement income. I'll talk about each one of these in more detail in the next slides. Dividend-paying stocks, REITs or real estate investment trusts, bonds, and annuities. Dividend-paying stocks can offer income as well as capital appreciation. On top of that, since 1972, the dividend-paying component of the S&P 500 has significantly outperformed the non-dividend-paying component. Over this time, dividend-paying stocks averaged 8.84%, while at the same time, non-dividend-paying stocks averaged only 1.74%. Also, dividend-paying stocks are less volatile. Next are real estate investment trusts. These are professionally managed portfolios of real estate. Some are focused in a particular area of real estate like commercial or residential properties, some in a geographic area. So there's generally a lot of choices. You need to be careful to evaluate all the risks involved and the track record of the company offering the REIT, but they can pay some pretty attractive yield. One more thing is that some of them are what they call non-traded, which means that they may not be very liquid. So make sure you fully understand all the details before investing in one. Okay, let's talk about bonds. Bonds are a very traditional component of a retirement portfolio, but there's a few risks that I wanted to point out for you. The first is credit risk, or will I get my money back? And the second is interest rate risk. With credit risk, there's two primary concerns. The first one is a big one. What if the company defaults on their interest payment? For this reason, it's very important to know what kind of bond you're buying, if it's secured bond or unsecured, and where it falls in the overall pecking order of where your bond gets paid in the event of a bankruptcy. With your retirement income strategy, you should stick with higher quality investment grade bonds. Any speculative bonds like high yield should be part of bucket 3 in the long-term category. The second concern with bond credit risk is a ratings downgrade. So if a bond goes from, say, A-rated bond to an A- rating, the value of that bond will likely drop, even if it's still making all of its payments. Now, the second risk is what I really wanted to discuss. It's something called interest rate risk. What this means is that bond prices are inversely related to interest rates. Basically, as interest rates go down, bond prices go up, and when interest rates go up, bond prices go down. So you can see how it works in this diagram, kind of like a mechanical lever. My concern here is where interest rates are today. Currently, the 10-year Treasury is hovering right around 2%, one of the lowest levels in the last 100 years. So how much lower can interest rates go? Probably not much lower. At some point, they're likely to start moving back up, and when that happens, bond prices will fall. Now, going back to our diagram over here, not all bond prices will be affected equally. Just like a mechanical lever, the bonds on the shorter end will have less volatility than the bonds on the longer end. The best way I can describe it is like this. Imagine that today you bought a bond for $1,000 paying 4%. If tomorrow interest rates went up to 5%, first of all, you'd be pretty bummed, but what if you wanted to sell it? Could you? Well, of course you could, but no one is going to want to buy your bond for $1,000 when they can go out and buy a brand new one for $1,000 paying 5%. So you have to discount the price of the bond to make it equivalent to all the other bonds that are out there. Now, if this was a bond that was going to mature next year, it's probably not that big of a deal. In a year, you'd get your money back and you'd be able to go out and buy a new bond, potentially at the new higher rates. But if it was a bond that wasn't going to mature for 25 or 30 years, that would be a big deal. You'd be locked into that lower rate for a long time, and so would whoever you decided to sell it to. So you'd have to discount the price more on a longer-term bond than you would on a shorter-term bond. The last option for creating income that I wanted to discuss is annuities. Now, annuities can be a great way to create a sustainable income stream for your retirement. There's 4 basic types of annuities: fixed, immediate, index, and variables. And they all have their benefits and limitations. Most of them, however, offer options for guaranteed income that can last you for the rest of your life. Some will even guarantee that income for your spouse as well. By creating an income stream from an annuity, it can help you to keep your first bucket full and take the pressure off other parts of your portfolio. In other words, by having a regular cash flow that meets all your basic retirement needs, you can invest the rest of your portfolio without having to worry about needing to take withdrawals when the market may be down in value. If you'd like to learn more about annuities, I have a great presentation up on our website where I break down all the different types of annuities and teach you everything you need to know before you invest in one. So here's a recap of what we learned. Using a bucket strategy is designed to increase your chances for success in retirement and how long your money lasts. Remember our rebalancing strategy to always keep at least 1 year's worth of cash flow needs in liquid assets. Dividend-paying stocks not only pay nice dividends, but their performance over the last 40 years has significantly outperformed non-dividend-paying stocks. Stay away from bonds with maturities longer than 5 years. They can really lose value if interest rates rise. And consider annuities as one component of your bucket strategy to create a lifetime income. And check out my video series on annuities to learn more about them. So that's it for part 4. I'll see you in the next video where I'll wrap up this video series with a recap of what we learned.